Welcome back this week. We have the pleasure of having Joel Cahill, who was 2005, right?
Yeah.
5 graduate of the MSF program, and who then upon graduation has went to Merrill Lynch in New York and has worked there in the same capacity since, although they went bankrupt during the process. But you had no responsibility for that, right?
Not directly, no.
None. So not directly. Anyway, so he is Vice President in Latin American currency options, and glad to be back at the University of Florida and talk to you guys. It's not too many years ago on the other side of the desk. And he'd like to take questions at any point in time. Got a presentation that you've seen. He's going to pull up some live stuff from Bloomberg on markets. So thank you very much for coming, Joel. Let's come back.
Thank you. As Dr. Brown said, I do want questions to be open. If you have anything, just go ahead and shoot away. I'd rather you ask the things that are relevant so that, we hit on those things rather than what I want to talk about, because that might not necessarily be what's relevant. So first of all, as going into, I interned at Merrill Lynch. I guess I should just to follow through. I graduated here in 05 with the MSF. I interned in 04 as an intern at Merrill through the sales and trading program. Started on the G10 options desk in 05. Did that for 2 years. In 08, beginning of 08, moved over to do Latin America, and I've been doing that for the last 2.5 years. Same capacity after we moved to B of A, which is basically the exact same thing, just in a different building. So I'll leave that as my way of introduction. What the job is traditionally, and when you're working at one of the investment banks on a trading desk, is as a market maker. Market making and prop trading has become, obviously a lot more important as far as what that distinction is, what that means, where are the risks, because of the people in D.C. they want to get their hands in it. So to explain what market making is, purely market making is that you are creating a market for hedge funds, corporations, central banks for the hedge funds to actually take risk in the currency market, for corporations to hedge their exposures, hedge cash flows, hedge their balance sheet. And the idea is they come to you, you make a market in something. And for me, what we'll get into is I specifically do currency options. It's an over-the-counter market, so everything is tailor-made. Whatever it is that you want, you come and you ask us, and we make that product for you, and then we risk manage it. That's what you do in the market-making role. So you take it on, and then you work to get out of it in the market. And we do a lot of our trading within the other banks on Wall Street, and we have brokers who go between us to facilitate those transactions. The idea is we're coming in, somebody does a trade with us, and we try to scrape a few basis points off, and you do that in, over the course of the year in billions of size, so that you can actually create some P&L. That's the theoretical way that it's supposed to work. It doesn't actually happen that way. Every trader always wants to have risk, so they're always going to end up running risk. Doesn't work well necessarily, but at least they will all try to do it. And every trader then says that it's for their market-making book. And that's why they have to run this risk. Well, that's then where you fall into prop trading. Now, purely prop trading would be very similar to if you were at a hedge fund as a portfolio manager. You put on a trade because you like the Brazilian real, which we'll get into. You could come up with a strategy to get long real, and you would just do that as a proprietary trade. I spend more of my time doing the latter than the former, though that's what I started doing. And not to get into the financial regulation bill, but there's the idea that they don't want prop traders taking the prop risk because they think that had something to do with taking banks down, though it had absolutely nothing at all to do with it. So the clients, as far as market making, we'll go through market making and who your clients are, what the trades that you would put on are, and this is what you would traditionally learn as you start in the investment banking, or as on a trading desk, and learn how to manage the liquidity, how to manage your book, and hopefully make money out of it. Since I focus on Latin America, what we're going to look at is a corporate in Mexico, and a lot of these Mexican corporates will have, if they're exporting to the U.S., they traditionally end up just keeping a whole lot of dollars, or they end up having naturally a lot of exposure to the U.S. because of the fact that if the peso changes in value, then that's going to obviously affect the value of their goods in dollar terms. So therefore, they were going to look to hedge themselves. And then we'll look to institutional trades, which would be something like a hedge fund might come in and look for to put on some risk in whether it be vanilla or exotic. We'll go through both of those and talk about what those look like. So a very traditional way that a hedge fund or that a corporate will hedge themselves is through something that they usually call a collar. In market terminology, it would be a risk reversal. So what this exporter might want is because if they're always selling to the U.S., as the dollar appreciates, then it makes their goods cheaper to their U.S. consumer, right? So you would say that they're structurally long dollars. So as the dollar appreciates, they actually are in better shape because it makes their stuff cheaper. If they're denominated in pesos, they're totally fine if the dollar goes up, and then they're just going to get dollars and turn them back into pesos. So what this allows them to do is to then put a collar on their position, something that will actually help to either manage their balance sheet or help to manage their future cash flows. And as I've put up here, sell away some of the upside in the dollar, while then if the peso happened to appreciate, the dollar going down, they've given away some of that. So this example here is that we'll say that dollar MEX is at 12.75. It was there a couple of days ago. Peso since rallied. So, but if we say the spot's at 12.75, I assume everybody's familiar with what a forward would look like, what a forward is, and that's actually, it's based on just the rate differential. Mexico has higher interest rates for various reasons, but they have higher interest rates than we do in the U.S. So you would expect it based on interest rate parity, I think is what we call that one, that the peso will tend to devalue over time, which means that because if it doesn't, then you actually have a trade. If the peso doesn't devalue over time, you can just sell dollars, borrow dollars, buy pesos, make some money. So what they might do is they would come to us and say, we would like to put a collar on our position. So where can we do something for zero cost? And usually what they'll say is at 12.25 through there we want to be hedged. So we'll say, okay, so you're going to buy a $12.25 put, and then we'll find out what it is that they can sell for zero cost, so that they don't actually have any premium outlay. And at that point we put a 15.50 strike on it. So now, as you can see, there's obviously some benefit here because you're a half a peso away from the 12.25 level. So you have 50 centavos there versus almost 3. You have 2.75 away from 15.50. Well, what that actually reflects is the fact that one, the forward is higher, so the forward's up at 13.23. But the other thing is the fact that the market pays away. The market pays away for peso protection in the event that a peso devalues, because there's far more risk to a large peso devaluation than a dollar devaluation historically, not necessarily these days. But that's why the client's happy to do this. They can walk away. They're now hedged. The dealer now has this position on. Yeah.
So maybe to clarify one thing, which may answer my question, but so everybody sees on that horizontal axis the forward rate is 13.23. So the forward things were more symmetric than what you described. Then the zero cost collar would be symmetric around 13.25.
Yes.
So maybe this answers my question, which is, why wouldn't someone just enter into a forward contract and take the currency out? Is there the currency exposure out? They're using this zero cost collar because they believe that there's a certain amount of a bet in it or a view in it. Is that how they would do it?
Yes. In the end, yes. I mean,
a lot of protection, but they're also speculating at some level.
Yes. I mean, there's some propensity for corporate treasurers to want to take some risk, naturally. So that's exactly what it is. Because they also look at it as, okay, well, we're basically risking 50 centavos here. Because a lot of people also don't actually think as much in terms of the interest that they would get. Rather than holding those dollars, they're thinking, where am I actually going to do my exchange? And until basically 2008, when the peso had a 20% deval in one day, every Mexican corporate who I would talk to always thought that the peso was going to gently devalue, and we would just go from somewhere 1050 to 1070, at which point then they would sell dollars and buy pesos, but they never did. So they would end up just putting these hedges on. And some of these hedges actually made more money in some of these corporations than the actual, yeah. So this is what the client's position would look like. The client has now sold away at 1550. This is where the client starts losing money, but not really. This is just on the trade that the client has underlying businesses. This is simply a hedge for. So they might actually be in better shape if we get up to 1550. So now, if we're looking at this from the market maker's perspective, because now that we've done this trade, the salespeople do their high fives, and then the traders actually then have to do their job here. And so what now I'm looking at as a trader is now, I've listed the Greeks up here, and I'm assuming that everybody's familiar with what the Greeks are, but I'll sort of explain as we do them. My delta here is 40%, meaning that let's say we've done 100 million notional on each side. What happens there is that now my exposure, the way that the trade will tend to move, barring anything else, barring interest rate moves, barring volatility moves, and assuming no change in time, I'm going to, a 1% move is going to be as if I had a $40 million position on, as if I'm long dollar MEX, because I've now owned the dollar calls and I'm short the dollar puts. So now I have 40% of my notional as delta. So the first thing to do is, because the thing that's going to cause the most P&L noises is sell this delta. So I will go ahead and sell $40 million dollar MEX in the market. And now I'm hedged on that basis. Now I have some Vega and some Gamma, which those aren't actually very large numbers for those. But what I'm going to now show you next is what that position actually looks like as spot moves. Spot being the underlying currency, the peso versus the dollar. And explain this as well, that the dealer, when I say he's got blow-up protection, he or she, we'll be careful. But if they have now blow-up protection, it's not unlike owning puts on the S&P. If you own puts on the S&P, that's usually when it tends to be more volatile as the S&P declines. So as the S&P declines, you would like to have more exposure to Vega. Very similarly, when the peso declines, you usually want to have more exposure to Vega, because that's implied volatility usually goes higher. Yeah, sure. Yes, you have the 12 and a quarter that we've sold happens to actually be closer to the money because of the fact that the dollar puts trade at a vol discount. I got it. So you have a lower implied vol versus the MEX put. So you actually, in this case, you could have, let's say, a 25 delta and a 15 delta, which is how then we get to a 40 delta as our net trade risk. One's positive, one's negative, but since we've bought one and sold the other, then they both go the same direction. And so what a market maker would do, this is a fairly simple one that you would hedge. I explained the first part as far as in a sell-off. I'm assuming, because I should say, CNBC, for all of the terrible sins that they commit for making finance look like it's like some sort of like game show. They talk about the VIX every day, right? When the stock market goes down, they'll talk about, oh, VIX is higher today, and that's a measure of implied volatility on the S&P. So you'll tend to see those move in lockstep, so that when the S&P declines, vols will tend to go up, and vice versa. So what now if the market maker says, I really would like to be flat this position, I don't really have much cares to have this risk reversal on. They would go into the market and they would look to sell the risk reversal. Now the risk reversal it's a generic thing. It's usually you sell 25 deltas on each side. For ease, if anybody doesn't know what delta, we're assuming delta is how much that position moves in value. If you have 100 million, it's going to move 25% of that as if you have your position. It's effectively the replicating amount to replicate it based on Black-Scholes. But which means that if it's 25 delta on one way or the other, it means that it is out of the money. So what we would look to do is we would sell the 25 delta risk reversal. Well, generically in the market, I put the strikes up there. Now, if you sell this risk reversal, you haven't matched your exact strikes, but you've gotten something close. So now you've actually managed to hedge some of this risk, and then you would actually just move on. Dealer would probably just move on. He's now hedged his delta. He's hedged his Vega risks by selling this risk reversal, and largely you just move on. That's the easiest way to do it, because in an over-the-counter market, it's different. You know, if we had done this on Microsoft, I could have the exact strike that I would want to sell and the one that I would want to buy, and they wouldn't have gone to me anyways, and we wouldn't have been able to make any money on it because we're not warehousing any risk. They would simply just do exactly what they could do on the exchange, pay a penny brokerage, and walk away. For us, this is something that we provide that is an over-the-counter market, you know, something that's very specific to what they want, to what they need, and then we deal with the rest of the risk, which would actually be fairly immaterial in this sense here. So now what I've brought up here is just so that you can actually see what the risk profile is before we had actually sold that risk reversal in the market. So this is where we are spot. Our delta is basically flat. We're short a little bit of gamma, and part of that is because you always have to think in terms of, I think one way to look at it is, in the options market, if you own an option, there's always some cost to it. Now, if you own a put on the S&P, there should be a greater cost to it for the equivalent call on the S&P because the S&P tends to fall faster than it rises. You know, they say it goes up an escalator and down an elevator. So that's what leaves us with a little bit of short gamma because we can't just have, you know, this position on and not pay anything for it. Being short gamma always causes some sort of problem as soon as spot moves. We have some Vega. We're short 100K of Vega. That's per one vol move in the implied vols because exactly what Dr. Brown was asking, why there's Vega to it, because it's a little bit skewed. Now, this Vega is a measure of your risk reversal exposure. That's when we talked about. The number itself isn't particularly relevant. What's relevant here is this is the peso depreciating, because as spot goes higher, this is the peso appreciating. What you can see is we're going to get, our position here, most importantly, is we're going to get shorter of volatility as we go lower, and we're going to get longer of volatility as we go higher. That's the type of position that you do want to run. Now, the problem is, like I said, you're having to run short gamma from it. If you just look at the top line, the P&L, you're going to lose money if you do nothing. Until spot goes to 13.55 because you've been short dollars because you've been short gamma. So now you're going to be short $8.5 million. The only value here is that you're long some vol. Now, if vols go up 3 vols, which is entirely possible, then you're going to be flat of P&L. So that's the way that the market maker is going to look at the trade. How is it that I'm going to want to run this? So let's say that the market maker in that case just wanted to get flat, so they sold the risk reversal. I think this is the last one of this one. If anybody has any specific questions on this, we're going to go into some others with risk photos as well. This is actually our internal risk system. So this is actually what I would be looking at.
Let me walk through it. I get it slowly. So look at this diagram, this table, and then before deciding whether to sell it off, you might decide to retain it.
Let's assume that this isn't the only position in the portfolio. Right. I had to isolate this after I put it into the portfolio yesterday to actually put it in. Now, if I happen to already be short risk reversals, if I was already short the blowout protection, some puts on the peso, then in this case I might have just said, actually this actually overlays the position I had really well, right. and I'm just going to keep it.
I guess as the peso itself moves, all these other Greeks move, but as you think about whether that's a desirable place to be in as the peso goes left to right, then in your mind there must be some correlation between, well, if the spot goes this way, volatility historically, or generally, or I have a view that volatility will grow and if it moves in this direction and shrink in that direction or something like that. Is that?
Absolutely. The risk reversal is effectively, the proper way to price it is actually the correlation between spot and vol. Actually, measuring that is far more difficult than that, which is why it becomes something that you have to, it's much more. It ends up being more flow driven, I should say. But in reality, if let's say you had a flat risk reversal, you had zero risk reversal, and in rate space sometimes you can actually get to a flat risk reversal, or even in euro dollar. but you're finding that vols are going up every time the euro appreciates and vols are going down every time the euro declines, then it would make sense that you would go out and you would buy the euro calls and sell the euro puts and just delta hedge it, because you know that when spot goes higher, vols have been going higher, and so you're going to get longer of volatility in the right spot. And Mexico will, almost always, will have the puts on the peso as the higher vol, because of the fact that you have. Yeah. So now then it becomes a question of how much premium should it have? How much am I willing to pay away for that? Does this make sense? I mean, this is. Well, Vega and Sega, it's different banks will call it different names. This is our internal thing. This is actually my exposure. Vega is my exposure to a move in the risk reversal, because we trade everything in implied vols. So I have a vol for my at-the-monies, and I have a vol for what my risk reversal is. And if my risk reversal is at 5 vols, meaning I pay away 5 more vols to own the MEX puts than to sell the MEX calls, then that means if that moved to 4 vols, I would lose 300 grand. If it moved to 6 vols, I would make 300 grand. Sega is it's a measure of, let's say, the smiliness of the curve, the amount of curvature, how much it kicks up. And that's actually a very small Sega number. Sega can run into, you could run a 5 or 10 million, Sega position, because that'll move maybe a half a vol. It would be a big move. And what we would call that is the butterflies, because you have your curve, and you're always going to have some smile to the vol curve, because it's sort of a way to account for some of the things that are missed by black shoals, effectively, but also to truly the fact that there are fat tails. There are reasons that you would pay for things that are farther away from the money. Then we have some skew within there that's based on the market's interpretation of the risk of vol moving one way or the other with a move in spot. Is anybody else? We had 12 and a quarters. We're short and we're long 1550s here in the 1 year.
So normally gamma is the highest at the strike, right? Maybe I'm not reading correctly here. You read along the row that's the gamma.
Uh-huh.
The highest value in absolute terms is around 12 point. Yeah.
Sure. Well, the on a spot basis, yes. But since it's 1 year out, the forward is also something that we have to take into account. And I forgot where did we spot? We said at 1275, and the forward was, so the forward's basically 50 centavos above spot, which would indicate that your shortest point in gamma should actually be somewhere around 1275, most likely in that case. But in truth, we have two things working. Is the fact that we do have a long strike that we have up higher up. So as we're moving away from that, that's also, we're losing some of our long gamma. But in reality, you're going to get the most gamma on this, because it's not actually a black Scholes number. It's actually a smile number that we actually trade off of to account for the move along the smile curve as spot moves, to account to basically forecast where the vol on that strike is going to change to. Because in a black Scholes environment, you value a strike, and you look at the Greeks, and it doesn't have any accounting. It doesn't account at all for the fact that vols go up or down with a move. So what everybody's systems now will try to accomplish is somehow relate how much vols might move, or how much the strike will move in vol, so that actually in this case the 40 delta downside, something actually a little bit below the strike, is what you would find the most gamma on, somewhere between 30 and 40 delta of a low strike. So that's what you would find. But since we have some interference here, because we do have that 1550 strike above. But in reality, you would expect that you would be at your shortest gamma point, probably around 1275 to 1285 on that specific strike, on just that 12 and a quarter strike. Okay, so now that's a corporate, and when we'll talk about what a hedge fund might do, which in truth is probably a bit more interesting. So we talked about Mexico, so we'll use Brazil as an example. So if somebody wants to get long the real, then they have various ways to do it. They could just simply just go out and sell dollars and buy real. That's one way to do it. But at the same time, there could be various reasons why they don't want to have that, or they want to have a more leveraged strategy, or they just simply would prefer not to have the cash because they don't want to have to stop out. Something very specific about the Brazil market now is that the central bank is intervening to try to keep the currency from appreciating. So is the rest of the emerging market world. And so there's times when the finance minister, Guido Mantega, is absolutely crazy about seeing the Brazil appreciate. So he'll just randomly come out with headlines and say how we will stop the Brazil from appreciating. We do not want to see this go any further. We have all of the power behind of the central bank and the government of Brazil to keep it from appreciating, because stuff is really freaking expensive down there, actually. And so, I mean, he has a little bit of a point. But at the same time, Brazil is one of the strongest economies, and they have very high interest rates, very high real interest rates, some of the highest in the world. So there's a lot of attractiveness to jump in and own real. So somebody might just not want to have that noise of having to worry about what the finance minister is going to say or do. And so they could say, we'll look at a dollar put spread, just a very generic contract or strategy. And then we'll look at an exotic, which is an RKO, a reverse knockout, which are very, very prevalent in our markets. It's the first generation of exotics. From there is where you sort of start to launch off into the more exotic products. So here we're setting spot here at 171.5 in dollar Brazil. We're going to have a 3-month expiry on this trade, and then the client's going to buy a $170 put, and they're going to sell the 165. So they have, you see, they have 5 cents upside, 5 real cents upside, so they have, that's about 3%. The cost is going to be 80 basis points. So you see, it's a little worse than 4-to-1. Bets that I usually don't like to make. I try to keep things north of 4-to-1 on a vanilla spread like this. But it's not always easy, because if you think about, if everybody wants to do this, then the returns are going to be marginalized. This is a strategy that a lot of people want to do. Brazil is one of the favorites of a lot of investors. It's the B in BRIC, of Brazil, Russia, India, and China, and one of the easier ones to invest in out of those. Certainly easier than Russia and China. So now what the client, let's just assume, because of this strategy, that the client has this view. The view would be, I like the real. I think that the vols are relatively cheap, because we're going to end up buying a little bit of Vega to start. But I think that the appreciation in the real will be gradual. Therefore, I'm happy to sell away the further appreciation beyond 165. Cheapens up your strategy, allows you to leverage it up a little bit more. This is certainly not unreasonable, as I just said, that the central bank is coming in to buy dollars, sell real every day in the market. So because they're doing that, that's going to slow the appreciation of the currency.
The price of this is
80 basis points.
80 basis points.
Yeah.
So how much would the price change overall for speaking if I wanted to move into 160, for example? What would be 700 basis points, or how fast does it grow?
Well, let's say if you went down to 160, and we're going to be roughly 6% of upside, right? And your price is not going to double, right. But your price. I mean, in this case, because of the fact that the 160s, there's a lot of skew in the Brazil market. So therefore, the lower the strike is, you're going to find that they're going to be at lower and lower vols. So you're selling something at a lower and lower vol, to the point where it actually might not be particularly intelligent to do. I think roughly this strategy was about 110 basis points or 120 basis points for the high strike, and then 30 or 40 for the lower strike. So as you went down, you might only end up getting 10 basis points for this thing. So you might cost 110, something like that. But then it starts to look much more like you just own the 170, because you're not selling away much upside. So in this case, I don't believe that. I think it was up 120 basis points or something for that 3-month contract.
So then what's the 3.75 to 1?
Just your maximum upside to risk. 30% divided by 80 basis points.
So you're right. So your cost 85 emotional.
Yeah. So if you put in $100, your best return is going to be 375. I think it's a marginal trade at that point. But this just gives you something to look at. So now what I'm saying here is that the client will run into short gamma and short Vega as we go down. Now that helps them on their mark-to-market, because in reality everybody's looking at things on a mark-to-market basis, not necessarily just on what's going to happen at expiry, because you have 3 months, and I certainly don't hold that many positions all the way through to maturity. So this is what their payoff profile would look like. Through 170, they're going to make money. At 165, they stop making money. And if it goes all the way down there, then they've almost quadrupled the money they put in. But now, since we're a market maker here, we're looking at what our actual risk exposure is. So somebody's come in and said, I would like to buy a 3-month 170, 165 real call spread. So we throw a price on it, we sell it to them. Well, my first thing is, what I said here is the delta is 22.5%. So I now have to sell $22.50 of dollar Brazil in the market. That's the first thing you do. Easy, you get that done and booked. That's what we have here. So now you can see that our delta is again flat. We're now short gamma because somebody's paid us for something closer to the money. So we're now short 3.5 units of gamma. We're short a little bit of Vega because, again, they paid us for something that's closer to the money, gave us something farther out of the money. So as you see now, as spot declines, which is the real appreciating, those start to change because we're now moving closer to the thing that we're long. Okay? Now, in this case, this is different from this is the opposite from what we talked about in Mexico. Because if spot's going down, most likely the real slows its appreciation. When the stock market goes up, vols tend to come lower because, for various reasons, but sometimes it's just because people start selling calls against their portfolio. People similarly will do that in Brazil. They'll sell calls against their position, take in more carry, take in more income. So now, as spot declines, we're actually getting longer of gamma and we're getting longer of Vega. So that's not necessarily the ideal position. But again, there can be a reason for it. There can be something that you want to get out of. So our first option here is we just have sold $22.50 Brazil and we run it. In this case, you might just keep it, or what you might do is actually go out and just buy a generic 1-month contract or 3-month contract so that you could, just like an at-the-money like straddle, so that you can actually hedge your gamma if you don't want to actually sell that gamma. Now, going through and actually doing the 170s versus 165s, it's debatable whether or not you would want to do that because it's something that you'll have some time to work out of. As a market maker, you're working on a thin margin. We're not getting in and having a ton of money to work with, and it's just cash sloshing around, and you can do whatever you want, and you make a few mistakes here and there, but you're still making a bunch of money. It just doesn't work that way, unfortunately. It would be nice if it did. So that's your position here. There's a very simple trade again. Let's go on to the next one. Yeah, go.
Have this exposure as a result of doing this trade. You take these things off as a choice, right? So intuitively, it's a no-brainer. You can just sell the delta because that's what the runner by cost very easily, right?
Yes.
Now these other things, do you have a sense of, or does the whole group have a sense of sort of how our P&L works? What's an amount of Vega that we feel like we're comfortable having? What's a reasonable price to sell it at? That kind of stuff.
Yeah, I try to have a game plan at all times where I think things can go. Sort of a base case scenario, given what other things can happen, and a worst case scenario, and sort of a best case scenario. In this one, when somebody's doing just a spread with you, unless they did it in $1 billion a leg, you're not gonna have as much exposure. 80K of Vega isn't going to be something huge. Excuse me. It's something that it's probably you're gonna be able to maintain it. If you did a trade that has 800K of Vega, then you have to think about it a little bit. It depends on what kind of P&L swings you're able to have and how much risk you're able to manage. And that's very trader specific, and depending on what his manager says and what your view is. If I like vols lower, then I might do this and then sell more vol. Because now somebody's just told me, if it's a smart hedge fund who's just said, basically, I think dollar Brazil is going down, I might say, I think dollar Brazil is going down too, but I'd rather actually play that by being short vol. Because short vol can be somewhat of a proxy for short dollar Brazil. So I could actually just play it that way and say, I agree with your trade, and I'm actually going to add to it on one side, one component, the Vega component.
And that would be, maybe to state the obvious, define where Vega is priced the most compelling.
Sorry?
That's what you're just then in the conversation about where Vega is priced the most compelling in your mind.
Yes, yes. So it's certainly one of those where I see what portion of the curve I think is going to be the most attractive to sell in that case, and that's the place that you're going to that you go for it. And if I think spot's going down and this hedge fund smart guy just came in and said I think spot's going down too, I might say, well, I'm actually going to sell some of the blow up protection because that's the thing that I'm going to get the most bang for my buck with.
Well, I guess that wasn't it. So I mean, if the other side of the trade is a hedge fund, do you think differently about this than if it's a corporate?
I'm a little bit different in this case. I try not to think about at all what it is, who's doing it. Some of the benefit of being on Wall Street is actually seeing what these guys are doing. But I've seen too many of them get steamrolled that I just, But you also don't know necessarily because these guys could have
You don't know whether they're reversing position or
right. It could be a more complex position against something else. I had a client just come in 2 days ago to put on a position with me, and I was on the phone with him, and I told him that I knew that wasn't his main position. It was going to be the hedge for the next position. Right. And he came in and did the other side the next day, which was actually a reversal of it, but he was just doing a cheap hedge to start. You don't necessarily know, and it doesn't make sense for somebody to always just tell you exactly what they're doing. Some guys are more secretive. Some guys are happy to talk about it.
So just esoterically, in a market like this, which is true of any derivative market, there are hedgers and there are speculators, right? Mm-hmm. So, what percentage of the sort of dollar volume that you see is obviously a corporate hedge
versus somebody speculating? That market, the market's changed. In Latin America, the markets have changed since 2008. There were a lot of corporates hedging, a lot, in Mexico and Brazil. A lot of these hedges turned into very, very large proprietary bets, and they didn't actually realize it. So some of those companies aren't actually around anymore. And then there's a lot more regulations about what derivatives these corporations can do. And the corporations don't want to buy options. Buying options obviously is the safer way to go, but they don't want to pay the premium because they got so used to either receiving premium up front or doing zero-cost types of strategies to hedge themselves, like the one we showed earlier. So the volume used to be more than 50% corporates, and now it's probably 75 to 85% hedge funds flow.
What you just told me, I might be kind of cynical about it because basically if hedge funds are going to make money, then if 80% of the market's hedge funds, at the end of the day they all walk away trading against each other. So that doesn't, then it's a harder game for me, right? Because then I have to pick the best one. When they were 30 or 40% of the market, they could be picking off hedgers very easily.
There's more low-hanging fruit.
Now it sounds like there's no low-hanging fruit. I don't know what the analogy is. Falling off the ladder, picking the fruit.
I mean, you're absolutely right. That's part of the reason why there's going to be a lot of change going on in the hedge fund arena. Not only just because it's coming out of DC, but also because of the fact that there's less low-hanging fruit. One of my good friends just opened a fund, and he's got a couple $100 under management, and doesn't actually know where to even start right now because it's just a difficult environment. Stan Druckenmiller just closed down one of his main funds, and he's one of the biggest and best investors of the last 3 decades.
So in other words, just to be clear, he doesn't know where to start because he looks around and everything looks fair, everything looks right.
There's nothing that's particularly out of whack.
Yeah, I was just gonna kind of, when you're talking about corporate companies, they're like international companies hedging against exchange rates.
Mhm.
Okay, what would be like the difference in a makeup between like people who are speculating versus these different corporate structures that are hedging against exchange rates, or would it generally be the same?
Well, I mean, you're saying like in their strategy, or
well, strategy-wise, like yeah, I guess strategy-wise, what would be like the main difference between someone who's an international business just trying to hedge their risk versus someone who's trying to make money off of the changing interest rate or changing exchange rate?
well, you now have, I mean, you have different objectives. A hedger has the objective purely of trying to maintain some value.
Okay.
So they don't come in and look at the Mexico risk reversal and think, gosh, that's really high, I should sell it. They're thinking, we just need to hedge our dollar exposure, so we're going to sell risk reversals. They don't even know that the term probably is called risk reversal because that's not relevant to them. What's relevant to them is what is it that we're going to be able to manage our cash flow or manage our balance sheet, and how can we go about doing that. Now, a hedge fund is actually looking at this, and they might say, well, it looks like there's been some flows that have come into the market where somebody's been selling MEX risk reversals. We think that those are relatively cheap. We see a lot of risk to the peso right now. So what we're going to do is we're going to go buy some MEX risk reversals, and we think it's prudent that we'll hedge those with Aussie risk reversals because we think that Aussie looks okay, and we think that this is actually a nice relative value trade. And so it's a wildly different approach. And naturally, as you have more hedgers in a market, and they're the less sophisticated, presumably they're going to be the ones who are doing trades that offer more value to a speculator who is more prudent in the market. Yeah.
You said things have changed since 2008. Does that mean that the corporate treasurers are using more forward contracts instead of these fancy things?
Yes. They're using more just directly of the most vanilla products they can. A lot of corporations found that some of these structures that they had put on ended up being bigger than they thought. When you have optionality in a small range, it looks one way, and then all of a sudden at the tails, it looks a whole lot different. And so a lot of them discovered that and had overdone their hedges, and that happens, and it can, it's taken companies down. I mean, Orange County, California is still one of the better examples of that type of thing.
That was interesting.
Right, but they do the same things in interest rate swaptions too.
I think that, can we labor that a little bit? Can you go back to the original risk reversal? I think that
This?
the picture of it. So I think that Reed asked a question. I think he learned something and I learned something as well. I think this is a pretty interesting point. So for the benefit of the class, that and Kyle's question about hedging, if they're entering this market, they're a hedger. Well, yes, but I think maybe start off by explaining to the class that if they really wanted to just get rid of the exposure to the Mexican peso U.S. dollar exchange rate, what's the position they put on? I mean, you said this a long time ago. Maybe go back to explore why they're doing this, what the implication is, and how this can blow up as opposed to a forward contract.
Okay. Yeah. In this case, if this company is structurally long dollars, like we said, what they could actually do is just get the benefit of going ahead and selling those dollars forward if they needed to hedge a 1-year exposure. Spots at 12.75, they're able to go sell dollars and buy pesos at 48 centavos higher.
And that will be a horizontal or a 45-degree line. That would be the contract.
Correct. It would just be pure spot positions. The same thing as buying a stock. Is basically, it's a 1-to-1, and that would nuke their exposure right away. But when somebody tells you can go into an arcade and they're going to give you some quarters, you might as well go play. Right. So, yeah, I think that's what the mentality is.
So they take this position on which says I want to hedge, but I do have to view. So this, let's state the obvious to the less sophisticated people in the audience, or the newer people in the audience. This is a hedge and a view.
And treasurers aren't necessarily instructed on how to speculate in the currency market. So. Yes, this is, well, sorry, this is a strong peso, this is a weaker peso, because it's how many pesos buy $1, or how many pesos it takes to buy. I very well could have, yeah. When we get back to it, I'll look at that. I don't. I just depends what was going through my head that day when I was. I mean, random, because my risk reports go one way, and people sometimes think of spot and up and down, left and right. I don't know. Maybe I was just feeling creative that day. But I tend to think about it left to right, so I would usually do this way. But you're right, I did actually go the other way. I usually think about it. Yeah, left would usually be. I flipped this one basically from what I would normally do. Yeah. No. If we're talking stocks, it would be very cut and dry. You'd pretty much always go one way. But in the currency market, when one thing's appreciating, it necessarily means something else is depreciating. So it's ambiguous. You can go whichever way you want. Yes, we do have considerable amounts of liquidity. Putting through $100 or $200 million transaction is pretty standard. There can be a couple of billion that trade a day of notional size. Well, I mean, everything trades there's a lot of generic contracts that trade: 1 month, 2 month, 3 month, 6 month, 9 month, 1 year. Every day, so it's a new date. And those are the actively traded things. So if somebody deals with me on some 3-week option, I might just hedge with 1 month because that's the easiest thing to get. But the liquidity looks different. It's not like monthly contracts like we have, in the S&Ps, say, monthly expiries. It's 1 week is liquid, overnight is liquid. A 2-week option is liquid, a 5-year option is relatively liquid. So there's any date will trade. Most of the people in my market will trade out to 5 years, and mostly 2 years and under, and anything within there really trades. It takes a little bit longer because people have to all price it up, see where their model comes in for any specific date, and then everybody, you hash away at a price. It's not an immediate thing, which is part of the reason why there's an opportunity to be a market maker in this OTC market.
Other parties may not be interested. So if you're talking about liquidity, I think this is the way I understand it. You're stuck to the contract. I mean, there's nobody else who would be interested in it, as opposed to contracts on the exchanges, option contracts. I mean, those are a different story.
You're right. But what we're trading a lot of is, if I'm trading something that's, a 1-week option today that's going to expire next Friday, I might have something else that I'd like to buy that expires Tuesday, and I might just buy that and sell that because if let's say I think there's going to be data on Monday, and I just want to hedge through that. The rest of it, I'm happy to be short the gamma behind it. I'm happy to be short an option. Then I'm just going to hedge that, and then you just run the risk. I mean, if you actually looked at our strike map of strikes, there's just thousands of strikes all over the place, and that's part of we're supposed to make money off of getting paid and given at levels such that we make money to manage those risks. That's the idea, if it works out well. But the next step is some of the more exotic products, which you certainly can't just call up a broker and say, can you get me a price on this, and I just want to get out. And those things you have to more efficiently manage. The RKO that we'll get to here is one of those first-generation exotics. I can actually get a price on it, but it's not necessarily that efficient to do it that way. Sometimes it makes more sense for me to actually actively manage the product.
So if he had on the next page, there's all the Greeks, right? So if he just sold over the counter something almost like the other side of this, right? But I guess if he doesn't, then he sells or buys all the Greeks to get flat. But because those Greeks move around on the spot, that's a very difficult position to be in. And you have to be constantly managing. It's much easier to sell an over-the-counter reversal position.
Right. If I could do the exact strikes just as liquid as I could a generic contract, then I would, or a generic strategy, then I would. But managing the strike risk that I'm talking about, as far as just selling the risk reversal, buying something from the client, and then selling something else in the market, it's close enough. It's the only time it's going to matter is if we actually get up to 15 in dollar mex, at which point we're in a totally different world, anyways, because the peso's devalued so much. And at that point, I'm not so concerned about this strike versus that strike.
The view of the writer and view of the buyer. To the writer, this is synthetic. To the buyer, this is the real thing. Right? So with synthetic, you have more options, no pun intended here, for liquidity. On the buyer's side, it's a different story. You're stuck with the DC contract.
Mm-hmm.
So liquidity, depends on whose side you're talking about.
The thing is, if you've got enough dealers in the market, they can call me, they can call somebody at Citi or Stanley or Goldman, and get ask that exact contract and get a rate that's 2 or 3 basis points wide in premium and be able to deal. If they're lucky, they'll get arbitrable rates between us. But it ends up that there's considerable amounts of liquidity. There's a lot of people who are in the market, so that you're able to get a good amount of liquidity. And when we blow up, then there's no liquidity anymore. But until that point, there is. So. Anything on this before we go to the exotic trade we were talking about? So now this one is, the strategy we had just talked about was a dollar put spread, a vanilla dollar put spread, where somebody would buy a $170 put and sell a $165, so that your payoff profile looked like this. If it goes down to $150, you've still made that same amount. Here, we now stop. And this is supposed to be straight down, so don't get caught up with that. But this is at 170. Now, you're starting to make money. This is at expiry, if you're at these points on expiry. Because this trade, since it is path dependent, has so much of a different look to it than does that dollar put spread. So now we go to here, and if we touch 165 at any point before expiry on that date in 3 months' time, then your trade's gone. Now you've paid 20 basis points for it, and once you now have 20 basis points out, if at any point it touches 165, it's gone, you lose your 20 basis points. But you can see that this offers you a lot of leverage. Now you got this you can have the same economics, assuming it doesn't trade 165. You can have the same economics as the other trade that was going to cost you 4 times as much. So there's a lot more leverage that you get out of this, and in some ways, as if you put this on and we have 3 months left, it's going to look similar to having the vanilla put spread. Until as time passes and you get closer to that barrier, the 165 barrier, then things start to look quite a bit different, because you can see what your ideal situation is. Your ideal situation is a grind lower, a gentle move lower towards 165 and ideally 165.01, and you walk away feeling like an absolute champ, because it doesn't ever work that way. But if that would be your ideal situation. The other is, let's say, where you can make some good money and take it off before expiry, is we start going lower and vols decline. Well, you think about this: if everything you have goes away at 165 and volatility goes to 0, then that 165 barrier you've sold away is worth nothing. So you sold something that's now worth nothing. So that's great. So as As vol comes in and spot goes down, that's your ideal situation, that's your ideal scenario as that hedge fund who's just bought this contract. I'm the dealer. I want the exact opposite to happen. I want spot to go down and vols to expand, because then I'm going to make money from trading my gamma around. So now what I've done here, because of the fact that, like I said, since this is a path-dependent option, does everybody understand that? If you have a 170 that's going to knock out of 165 trades, now you're very, very concerned if every time it gets down towards 166 in spot, if it trades 165, you're out, you're gone, you've lost your premium. So that means that the fact that if you had that vanilla put spread, if it went to 155 and then back to 175 and then at the end you end at 162, you make the same money. This strategy is gone. You've blown out. So if we put this trade on to start, and this is me, the market maker. I've sold this option to this client. You see up top, most importantly, notice here, because this is just below 165 would obviously be somewhere in here. It's gone. Like all of my Greeks are gone. So I've put this trade on initially, and there's no delta to it. It's no delta. It gives me a little bit of gamma because what we can do is we can actually break this trade down to look much more like now a $170 put that I've sold, and I actually now own what's similar to what we call a one-touch. Because if 165 trades, then there's basically a payout to me. And the payout to me is the fact that I get to tear up a $170 put that's in the money. Do people follow that? Like a no is actually a great answer right now. Perfect. You're doing good. So now what we have is this contract where the speculator would like to see spot go down and vols come in, things to stop moving. So at 3 months, you see it doesn't really look like much, right? Ignore the P&L in there because it came up wrong in the P&L when I had them run it yesterday. Then now let's say we just fast forward 2 months, okay? Nothing's been done on this position. And so you can actually see that there is some relevance to this change in P&L here. So with 1 month left, I've actually lost some money. I've lost 130 grand over that 2 month period. The idea is that as a market maker, I would have been able to trade some of this gamma. I have a little bit of gamma, so if spot goes down, I would be able to buy some dollars. And I just realized this. The delta here came up in REI, so you have to flip that sign. Okay, so if it says I'm long REI, that means I'm short dollars. We've been talking in the other terms about being everything is denominated in dollars. So this is BRL. So as I go down here, this is showing that I'm getting longer, it says, right? But that means I'm actually short dollars. So if I'm long like almost 17 real, I'm short like 10 bucks. So down here I'm short 10 bucks, so I would be able to then come in and buy those $10, 10 million bucks. And if spot goes back higher, then I can sell those things back out. That's where I'm able to make the money back that I'm going to be decaying away because I have this option on with this client. So this is with 1 month left. This is where it starts to get toxic because again, now let's look. If I've now put this option on with this client and it's a $170 put that triggers at 165, it's gone. We said that was about 3% upside, right? They put it on at 100 million. That 165 one touch, if it triggers there within that last week, that's a $3 million P&L swing for me. So that's when we start talking like, real numbers. So as now spot's coming lower here, you can see how much my P&L has actually changed. I'm down 600 grand if we've gone through all but 1 week of the life of this. I now have a lot of gamma, right? So this gamma can be valuable. Just to put it into perspective, if I'm long 60 units of gamma, and we've come down here, and let's say I buy $60 of dollar Brazil, and we pop 1%, I can sell those out. 600 grand. I've just made that P&L back, and I'm feeling okay. The problem though is this spot can go right back lower, and we can get closer to 165. I'm about to be writing this client a $3 million check unless something else happens, unless this thing triggers. So then what I end up having to do is I'm going to have to hedge myself. And I'm going to go out and I'm going to end up selling some short-dated options to take in some premium. It's going to sell gamma, but it's going to end up giving me some premium because if this thing doesn't trade, I still have an obligation to pay this fund $3 million bucks if we're down at 165. It's going to be somewhere between 0 and 3. And so I now have to hedge myself. But what you can see, this is fairly aggressive, these moves here. Being long somewhere in the 60 million units of gamma to all of a sudden being short gamma. Because 60 million units of gamma is a decent-sized position now. So like every 1%, you have a $60 million move. So if I'm long $60 million of gamma, and we go 1% higher, I'm long 60 bucks. How much have I made? About 300 grand. Because let's assume if we're long, uniformly we're long $60 million of gamma, and we went from 0 to 60, then on average we're long about 30 bucks in there. So we've made about 300 grand within there. So those are meaningful P&L swings. So now if we go from something where we're short 60 to then being to long 60 to short 8, and I want to go sell 60 million units of gamma down here, I'm going to sell 60 units of gamma, but when I sell a vanilla option, it doesn't have the same profile than an exotic does. Because again, this exotic, all of the Greeks have to expand and then go to 0 right as we trigger this barrier because of the fact that it's digital. If it triggers, it's gone. So these things can be pretty toxic. But
back to my statement again, hiring a hedge fund manager. If one were a hedge fund, and a strategy involved by RKO, I'd be pretty cynical just because I would say to myself, well, in this case, there is no one. This has to be hedge fund against hedge fund, or is there a true hedger that buys such a contract, or is this just a hedge fund against hedge fund kind of a space?
well, in this case, what we would try to break it down as is I'd say some hedge fund A comes in and pays me for this 170 RKO 165. I might call up hedge fund B who's really, really bullish the Brazil, and I might say, hey, I've got this 165 one touch. I've got $3 payout of this thing that I can sell you. So then what's happened now is, since I said if we try to break this thing down, it's not exact, but very, very close, into a $170 put and a 165 one touch, then if I sell away this 165 one touch, I now have a vanilla that's very easy to hedge.
That's for you.
Yes.
Mark, in terms of me, if I know a hedge fund, who plays in RKO besides hedge fund? Would there be a natural hedger? I understand that
Yes.
I know that you're not playing with it. You're just mediating. You're just passing paper back between the hedge funds with different things. That's great for you to be. But is there I've heard stories of knockouts and knock-ins in oil where there's a real reason that somebody actually owns it. That's what I remember hearing.
It's harder to find situations in which a corporation's exposure changes based on a certain trigger event of spot. But Kikos, which are knock-in, knockouts, they were talking about how all the Korean corporations had them and they got blown out of the water in 2008. Turkish companies have done it. Mexican companies have done it. Brazilian companies have done it. You can't really, I mean, I'm sure there are times when it makes sense.
I just had a quick question. So this is your risk as a dealer.
Yeah.
So if the buyer, on the other side, if it starts to tank and like really early on in the 3-month process, do they do anything to like, I guess like hedge their hedge, or is it just like they bite it and that was just like the risk that they took?
Depends. It's going to depend on the trader at that fund. If they buy this, they've only put 20 basis points out, so they might say, I'm just going to forget about it, because they don't want to chase the real as it appreciates. That might have been specifically the reason for doing this. Sometimes you actually have to put a position on so it's somewhat of like emotionally stabilizing, so that you don't that way you don't chase a market.
Right, because like I said, you can pick it apart and do what you can with it, but can they do that on the same, on the other side at the same time or not really?
Similar. I mean, if a hedge fund, if it's coming lower and they decided in this case that they wanted to protect themselves, they could go buy a 165 one touch, and they would turn their position right into that vanilla. I don't think it would make sense for them to do so, because then they're going to be spending all sorts of money on a position that's...
That was like they took that risk in the first place.
Correct. Yeah, when you buy an RKO, your view does need to be that this position is going to work out terribly for the dealer. Because the dealer, you want to get down here, spot to stop, you're going to be earning this decay, this is your theta, and you want vols to come in. So every vol you're making 100 grand, and every day you're making 100 grand. So you want, that's what you're thinking. I mean, in reality, you don't want your dealer to get hosed, but you make most money when your dealer gets smoked. So.
To kind of play off of what Dr. Brown talked about, since this is a path-dependent product, the underlying has to be some sort of an exchange-traded product.
There has to be something that's somehow visible and agreed upon when it triggers.
Okay, so you have some way of actually measuring where it's been and where it's, well, hopefully where it is right now. If you actually enter into one of these trades, now this is arguably a zero-sum game. So somebody's losing out a lot of money if you're up $3 million. And if the underlying actually goes to 165.01, what's going to prevent the other side of this trade from just entering into a large trade and pushing the underlying down a tenth or 100% and then reversing it immediately and wiping out all the earnings that you made?
I can't say it wouldn't happen.
It just sounds like you'd have a lot of incentive to exit out of this trade before it actually gets to that point.
Yeah.
We're talking about selling off gamma as you're getting closer and closer to 165. Is that something you can actually make a profit off of selling that gamma?
You can, yeah. If it's done well, if it's done right. It gets to be tricky. Because as you can see, when you have a risk on here, with a 1 or 2% move with a very large shift in your gamma, that can't really be recreated efficiently with vanillas. It can be, I should say, but not in an over-the-counter market where you're going to have to pay bid-offer spreads on both sides.
So if you were actually holding this, you'd probably never actually let it get to 165. You'd start reducing your exposure or start hedging your exposure at some point before that.
You might. Some guys want to just sit on it. Some of the hedge funds might just want to sit on it. And if we're getting down towards 165, the other thing that actually complicates this and can cause some problems is if we've gone down here and I'm getting short dollars, I'm going to be buying dollars as we go down there because I want to hedge myself if we go back up. Because let's say we have 1 week to expiry and we're at 167.50. So we're somewhere between them, right? I don't know if we're going to go back up, if we're going to sit right here or go down. Let's say we go another figure lower to 166.5, okay, where we are here. All right, so now let's say I'm going to be short 60-ish bucks. So I'm going to go buy 60 bucks of delta. Now, if we just sail right through 165 immediately, my trade's gone, right? But I'm still long 60 bucks of delta. So I need to go sell those things out immediately. So I actually have a stop loss on my position against that barrier. So if 165 is trading, I need to sell 65 bucks. That doesn't really help the client's position, obviously, because I'm actually pushing it into that level. It's not necessarily something that you're going to do aggressively. It's something that you have to do for your own economics. Because I have to unwind my position to get out of it. You understand what I'm saying? Because if I don't, then I'm left with a position still. So, it does happen where you have a battle at a barrier. I mean, literally. It will be at 165.01, 02, and somebody's selling here, somebody's buying here, and it just sits there. And you can have $1 billion go through, and then finally it triggers, or somebody comes in and just rips it higher. It can go both ways. They can get really nasty. I mean, I've sat on a $2 or $3 million decay bill overnight, and if it didn't trade, I was going to be out that money. They're not pleasant.
So yeah, he raised an interesting point. So with I never thought about these knocked out. So the knocked out 165. That contract says that the price is 5 p.m. Eastern time based on what?
It's an excellent question because we have disagreements over, and this one being that it's Brazil. Brazil's a non-deliverable market. So if you're an offshore, you or I want to go buy real, we can't do it.
Right.
Unless we actually had local capabilities. Right. So what it actually is there's an NDF market that trades, a non-deliverable forward market that trades. But since the trigger's based on spot, the forward and spot have to have some relationship. Right. Which in Brazil, it's called the casado. which is the spread between the forward and the spot, which I understand happens to mean marriage or marry in Portuguese. I'm certainly not fluent there. But that difference is, so you have to take the forward minus the casado, and when it trades, it trades. And it has to trade in $3 million, what we call market amount.
So some exchange keeps track of those trades.
Yeah.
Those things.
Yeah. It trades down at the BM&F.
Somewhere in the same time frame at 3 million, and that's the official record of it.
Yes. And those things can be pretty hairy sometimes as far as actually like a client doesn't think they were triggered, and then they'll ask other dealers and make sure that it was, and that happens.
So when you're in this position, obviously you have some sort of exit strategy if it goes wrong. Do you kind of incrementally hit yourself along the way to start getting nervous, or is there a certain event that triggers, all right, I'm going to get out of it?
As a market maker, you need to do things more in bite-sized pieces, because you can't abuse liquidity because you're getting paid to provide liquidity. So if I go out and then just all of a sudden just do some blowout hedge, then all I'm doing is I just paid Morgan Stanley to take the liquidity that I provided for another client. So you have to do it in small enough amounts and at the right times in order to actually maintain some of the money that you made on the outset.
Because that's the start you made from day one, where you're kind of setting it up. What if it goes wrong and you're slowly kind of putting the pieces in place for if the worst case scenario happens?
Yeah, and in this case, since if you look at the first slide up there, you see that there's not a lot of Greeks to it. But as time goes on, then if this thing hasn't triggered, then you're going to have a lot of exposures. You have a lot of things you got to do. So it is something that as time moves forward, and you haven't triggered that barrier, I've had something that's called a double no touch, where somebody buys this contract from you, and so now let's say it was in Mexico, it was a 12.25 and a 13.50. I wanted one of those sides to trade for me because that triggers it. Client doesn't want it to trade, and he gets a payout if it doesn't trade. This contract, we went down to 12.27, I think, didn't trigger it. 4 days later, or it was longer than that. I think it was a week or two later. We're up at 13.50 and triggered that side. So, you do have to be careful on really how you manage these things, because that was something that you could get completely steamrolled by.
So you guys got nervous when it got to 12.25, took a position on it.
Because if I started selling out on my hedge, and then all of a sudden it rips higher, I've got to stop that back out. Yeah. Any other questions?
When you are a market maker on stock markets, sometimes you have enough time to make this particular stock, for example, much people like usually move by like 2% before you don't get $1 million particular stock. I'm not really familiar with currency markets, so are you strong enough to make, for example,
That would be a very, very big move. I mean, that might take a few billion. So that would be a big one.
For example, if you close enough to the year,
Theoretically, I certainly could. Yeah. You absolutely can then. I mean, if you're close enough. I mean, I wouldn't necessarily do that, but it's certainly possible. Go ahead.
What are the haircut numbers for the currency trades?
It's all fairly small. There's a lot of leverage. I don't really even know, though. There's a lot of leverage in the market, and because it is liquid, if you need to get out, if you have to be stopped out of a position by your prime broker or something, then they can do that. We've got one more strategy to talk about, and hopefully everybody still has some sort of appetite left. We've basically gone through all of this here. We really discussed all that, so that'll be a little bit of a review, if anybody actually cares to. Okay, so now this is something that this is actually a real position. I've made it such that it's a little bit more of an obvious trade now, but this is actually a position that in some capacity, we ran for 9 months on our desk because it worked. Euro-dollar vols. Euro-dollar is very liquid. Dollar-Brazil is pretty liquid. The volatilities of each are observable, tradable, hedgeable. Euro-Brazil, when you combine those two, is not just Euro-dollar and Dollar-Brazil. It actually does incorporate some correlation between the two. Now, that correlation, usually what we would do is because you can take it two ways. You can either solve for what you think a future correlation ought to be, and then create the implied volatility of Euro-Brazil from the components. Or if there's a traded Euro-Brazil vol, then we can back out the correlation. In this case, Euro-Brazil trades, so we're going to use what we were observing. So I've put the equation up there so that you can actually see what it is. I'm not highly concerned about getting particularly technical with stuff. Not that this is all too involved. But what you have in these markets is, this is an excellent example of what Dr. Brown was referring to. The Euro-Brazil market is very, very largely dictated, the vol market is very largely dictated by European corporations who have large portions of their assets in Brazil. So they do collars to hedge this. This then drives that market. Their trades are actually very similar to the type of trade that we were looking at with the Mexican corporate, except the other way around. They tend to buy the blow-up protection, the Brazil puts, because of the fact that they have all of these assets in Brazil, and they're European corporates. So they need to hedge against any big swings in the underlying currency in Brazil. So now, what we have is we have a market that's not wildly liquid, but it's also very heavily dictated by a hedger who is very, very big, or a group of hedgers who are very, very big. So this is where we create one of these market opportunities, because you have a player who's, let's say, less efficient as far as their risk view, but because they are just purely concerned about hedging, and their hedging needs are so big that the market has a difficult time consuming them. So we'll go ahead and get right into it. So now the way that we can back out the implied correlation or solve for the implied vol is XY cross vol, we'll say, is Euro-Brazil cross vol. So it's the square root of, or we can say the variance of the vol, because the vol is just a standard deviation, is component 1 squared. So it's dollar-Brazil variance, euro-dollar variance, minus 2 times the implied correlation, rho, times the standard deviation of each. So in this case, what I've done is put the implied correlation very, very high. At 80 correlation, we're assuming that euro-dollar and dollar-Brazil are very highly linked. That's actually, well, I should say that's high, but we actually managed to put the position on around 75 correlation, I would say, is where we sold correlation. Now, if I'm going to sell correlation in this case, as you can see, as correlation goes higher, as your row number goes higher, your implied volatility of the cross declines. Because if euro-dollar and dollar-Swiss are highly they move in the same direction, euro and Swiss move in the same direction, which has historically been the case, and Switzerland would prefer it that way, then they're going to have a low implied volatility between euro and Swiss. You know, it's the same thing if Dell and HP, every day one goes up 1%, the other goes up 1%. The next day they both go down 1%. They're not moving at all against each other. There's no volatility between those two because they're correlated at 1.
How's the implied correlation set? Is that something that you guys do, or is that like market?
I mean, it depends. There's Euro-Brazil is something that's traded, so I'm going to see a vol out there in the market, and then I can look at what the implied correlation is if I want to study it. But now if somebody comes to me and they go, we need Aussie-Brazil, that's not really traded. So I'm going to have to think about what I want this to do. What am I going to hedge it with? Where do I think the correlation between Aussie and Brazil is? Where do I think it can go to? Where am I happy to have it or be short it? That kind of thing. So if I want to get short this correlation because I think it's going down, then I'm going to need to buy the cross vol. I'm going to need to buy Euro Brazil vol. You can see that we have a 12.5 vol on dollar Brazil, 11.5 vol on euro dollar, but just over 7.5 vols for Euro Brazil because of the fact that in this scenario we're saying that the implied correlation is telling us that Euro and Brazil move in tandem for the most part. So Euro Brazil doesn't move. Well, part of the reason that these vols are so low is the large reason is because of flows, corporate flows, that happen to put a lot of Vega into the market, so it just squashes it. At some point, that trade makes sense.
So just to help the correlation trade involves being long two options and short a third, is that right?
We'll go here. So what you do is now you're going to buy your Euro Brazil vol.
It doesn't have to be a straddle, it just has to be a gap, or does it have to be?
It can be whatever you want, but straddles are just the easiest way. You buy a straddle, you don't have to deal with delta. Yeah, any option, yeah. So if you buy at the monies, if you buy straddles, then you don't have to worry about delta. So it's clean. You buy it, see what happens from there. So let's say we want to sell this correlation. So we can buy the Euro Brazil straddles. So we're now going to buy that low vol at 765, right? And then if we wanted to totally work it all out, then we'd do what I'm saying there. Sell some of the dollar Brazil straddles, sell some of the euro dollar straddles, and you're not going to end up selling the same notional amount. But this is what we get to, and you would never do it just perfectly. I mean, I guess some guys might. I don't really know. I certainly wouldn't, because if you're going to put a trade on, I'm going to put a trade on, and hopefully it works. So what you have now is this is where you start to see where the opportunity comes in. Because this is what our actual Greeks are. I put a position on, and I'm not worried what their strikes are, where they are, where they're placed so much as I am like, what are my economics? What's going to happen when spot moves? Where am I going to make or lose money? So right here now we've put on a position where, first of all, one of the most important things to look at is the fact that we're not paying any decay, right? So net on our Euro Brazil position, we're paying 10K, but we're earning $5,000 a night for this, okay? Now our headline gamma, we're short 6 between these two. Long 15 here, so we have 9 units of headline gamma, let's say. But when there's correlation component, obviously that doesn't work perfectly. But let's just assume now that this thing is perfectly correlated. Dollar Brazil goes up 1%, euro dollar happens to go down 1%, meaning that the real and the euro are moving in the same direction and the same amount. Euro Brazil just went nowhere. So I'm now short $3 Brazil, and I'm long 3 euros. Or $3 worth of euros, because these are in USD amounts, and I have no love from this. So, I'm down like 30 grand on that. But the other way to look at it is, let's assume now that dollar Brazil happens to go 1% higher, and euro just goes nowhere. We're now going to be long Euro Brazil. Euro dollar's done nothing, so that's gone. And then we're short a little bit of dollar Brazil. So what it looks like is we're now long some euros and long some dollar Brazil because of the fact that this is outperformed, when we look back on our correlation. Are you following? Because this is a trade that was something that offered a lot of value. It was something that appeared, and it actually lasted for about 9 months. And on a day-to-day basis, assuming that euro and Brazil didn't just move in tandem, there was going to be some money to be made here.
They were priced as if they were moving in.
Yes, the implied correlation had gotten pushed up so high that's what allowed this trade to materialize. This is...
As long as they don't move close to in tandem, you make money.
Right. This now is actually where we're starting to get into, the hedge funds might do a dollar put spread. They might do a dollar RKO in there. But this is when you talk about like somebody actually trading volatility. This is what they're going to be doing. You talk about when somebody's trading an interest rate product, a lot of what they're looking at is actually correlation. If you're looking at, you're going to trade different tails on some interest rate product, you actually might be trading the correlation between where the 5-year forward 5-year rate trades and the 5-year forward 8-year rate trades, because something can get funny in there, and the implied correlation might be really attractive. The same thing happens in the S&P market. You can sometimes, the S&P 500 is just a basket of 500 companies. So if those 500 companies are all moving in tandem, then you have basically the same volatility of the underlyings as you have of the S&P. But now if you have lots of dispersion between those, then you can have a lot more volatility in owning the underlying actually versus being short the S&Ps. This is where the hedge funds really start getting in and getting involved. So you have a trade here that basically, I would tend to look at this and say, I've created some pretty cheap optionality for myself. Assuming things aren't just perfectly correlated, which is a rare thing, then I'm, for the most part, going to be making some money. Given that your reactions are highly underwhelming, I'm going to try to do, we might have lost this one. Do I actually need to push power on it, you think? Yeah, I think that might not have been the right idea. I don't even have this one here. But a great example of this was actually, go ahead.
I was just going to say, so when the correlation is that high, if a bunch of people jump into it to try and capitalize on that, is that going to push the correlation back down?
Yeah. But in this case, people weren't looking at this trade so much. I think I might have blown it.
Just because it has different levels to it.
Well, people understood the trade. But this trade came about middle of 2009, beginning of 2010. And people didn't have really the stomach to sell many options. And this would have involved selling a dollar Brazil option. Dollar Brazil in 2008, we went from 155 to 260. That's a big move. If you're short any option, it doesn't matter at what price, you got hosed. Dollar MEX volatility in that period went from about 5 vols to, I was telling Dr. Brown, the highest vol that I sold was 87 vols. And this was in a market that would, at its peak, go to 7 vols. And we went to 87. So in 2009, this is part of the reason why this trade came about, because of the fact that people were panicked to sell anything. So they were much less likely to put on some trade that would have involved one of the legs actually selling some of this thing that could really, really blow up in your face. But what I'd like to show you, so that it makes it a little bit more real, is I mentioned Euro-Swiss. Euro-Swiss has historically not moved very much. The correlation was very, very high because of the fact that the SNB, this the Swiss National Bank, had a desire to keep those together. So they would try to keep monetary policy roughly the same. I mean, Swiss interest rates used to be considerably lower, so a lot of people would try to buy euros and sell Swiss as a carry trade because there was such a low volatility. And it had produced pretty good returns until, as every carry trade does, it carries somebody out. It's not actually named for that, but it's probably more appropriate that it should be. So what has happened now is that correlation has declined hugely, so that the Swiss franc moves around a ton, because the SNB intervenes in the market to move it around sometimes too. So what I want to show you here, if we get it up, is actually a real life scenario of where that correlation broke, and you actually would realize that P&L very, very quickly. Because in Euro-Brazil, the correlation didn't so much break as the market realized that it was too cheap. And so they started pushing that Euro-Brazil vol back up. And it happened exactly in this way. And it took people time until about February or March of this year where they started realizing that trade, which is the point at which from my perspective, we realized we didn't need to manage this. We didn't need to run this position anymore, because if everybody else is involved, then I'm probably done. I just try to be a really nice guy every day.
Is it the customer satisfaction that allows you to do the trade volume, or is it the speculations?
I mean, it's sort of a perverted thing in that keeping clients happy and losing money is sometimes better than making money and making clients unhappy.
You get a lot of flow.
Theoretically, yeah.
So how do you make a client happy? Great ideas or?
Great ideas. That's what you're supposed to do, yeah, to show them good ideas. Good execution is what they want often, because they don't necessarily want to listen to your ideas. These guys have their jobs because of the fact that they're pretty good already. So this is euro dollar versus dollar Swiss. This is the implied correlation. And some of these, you have some hiccups in here, but roughly, we're running 95 correlation here, which would indicate, right, that euro dollar and dollar Swiss don't actually move that much against each other. So let's put up So, something to watch, to look at in here is, part of the reason why, if we just zoom in here, this isn't moving very much. We're talking for a couple of months, we went from 160 to 162. We were moving, at most 1% in there. So the implied correlation would naturally be very, very high. You're not going to pay a lot for an option on something that's just not moving. If you are, you're going to get given it in a size very, very quickly. So then what happened, though, is the Swiss franc started appreciating fairly actively. And the Swiss National Bank didn't actually want that to happen. So you have spikes like this, where the S&B has come in and bought a whole lot of dollars, dollar Swiss or euro Swiss, and takes it a lot higher. So you can just see it, right? How the implied correlation must have changed. Volatility has expanded. Therefore, you have to see some change. So now, if we let's pull up one more. If we look at here. Yeah, this is DEC. Yeah, last year. So now, if we look here, let's look at 3-month volatility in euro Swiss over that period. I wish 08 didn't actually happen, so I could just take this out, and we could just go like this, and you could see that it went from 4 to 6 to all of a sudden went to 11. Because that implied correlation has now declined so materially to the point that if we actually look at dollar Swiss volatility, which obviously used to be right on par with euro dollar volatility if euro Swiss didn't move, but now dollar Swiss is moving. This is 3-month volatility. This is a chart of 3-month dollar Swiss vol. It's trading just a little bit above. Well, it just popped up pretty aggressively, but it's been trading right around the same place that euro Swiss has, and that's going from when euro Swiss vols used to be. I was trading them at 3 handle versus a 10 handle or a 7 handle or 8 handle for dollar Swiss, and now those things are on par because of the fact that we've had a change in correlation. And the market also thinks that's going to stick around, because that's the other important thing, is how much the market actually believes that this is going to stick, that a lower correlation is going to stick around. And the issue here is people who had traded euro Swiss for years are more likely to sell it at 5 and sell it at 6, and then when it gets to 7, they're realizing that they just probably blew out their year. So at some point you end up having to stop out, which is why you get to 10 or 11 vols for these things.
Quite different for different expirations. How see that in the short run, the correlation can be very low or very high, but in the long run, it's sort of expected to average out. Do you see that kind of thing in the long contracts? The correlations never move very much.
Yes. You'll see that in the longer dates that the correlations won't move as much. A lot of these things, the reason why something is, if it's a cross like this, it's probably something that a hedge fund is taking a position in or a corporation is hedging with. And not like Euro Swiss, it's a very active one, but something else. And that can drive these prices to different levels. So it can, if the flow's in the 1 month, it can drive the 1 month. If it's in the 1 year, it can drive the 1 year. You usually see over time that it tends to go back towards what the implied correlation will be priced in where the historic correlation has been. It doesn't necessarily mean that's where it should be. That's just what market makers do. Since it's an over-the-counter market and it's not actually going to be recognized, then they'll just go about it that way. So this shows the this would be realizing the P&L on the trade that we've talked about. Because in this case here, let's just assume that this is Euro-Brazil. And so in this case here, we're long this Euro-Brazil vol, we're short dollars and euros. So what would have happened here is Euro-Dollar and Dollar-Swiss vol didn't go up nearly as much as Euro-Swiss. So in this case, we went from, in the 3 month, let's say we put it on at 5 vols. We're up 5 vols in this thing, 5 to 10, roughly, because the euros and Dollar-Swiss went up some. But it's something we could have made $1.25 million on because of the fact that this correlation all of a sudden came down. That's where you actually are realizing the P&L on it. I'm not even sure what I have after this. Yeah, that's where we leave it.
You spoke earlier about client secrecy and how they may not want to divulge what they're doing to you. This is a pretty straightforward trade, and I would a straightforward strategy. And I would assume that if you're actually serving all 3 trades for this strategy for one of your clients, you're going to figure out what he's doing pretty quickly. And you've got other clients who would also potentially be interested in this. So if there's a hedge fund who actually wants to implement this strategy, are they going to place the trades with other market makers? I would assume that they don't want you to know, because as soon as you know, the entire world knows what they're doing.
Depends on the relationship you have with the guy at the fund. I have some buddies who will talk about the strategy and then just like, all right, let's do it. And we'll both do it together because we both find that we like the strategy. Some of the guys want to be very, very secretive, so they're going to go buy it from one guy, sell something to the other guy, and that type of thing. It's not always cut and dry. But do we have any other questions? I don't know how to turn this puppy off.